NVIDIA stock is up over 1500% since 2020, but that's not even the most impressive number. NVIDIA's data center revenue went from $3 billion to $194 billion in the same period. That's not a typo. In 6 years, NVIDIA built the backbone of the AI revolution, and the market rewarded it with a $5 trillion valuation. But the question everyone is asking is the AI spending cycle peaking, or is this just the beginning? I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down NVIDIA using our 5 key factors: economic moat, return on capital, growth, financial strength, and valuation. The moat is always our starting point, because if a company can't protect its profits from competition, everything else is irrelevant. Morningstar rates NVIDIA a wide moat, and the reason comes down to 2 interlocking advantages. First, intangible assets. NVIDIA has been designing GPUs for over 3 decades. That accumulated engineering expertise in chip architecture, performance optimization, and thermal design is not something a competitor builds in a product cycle. AMD is well capitalized and moving fast, but it remains in a position of software weakness. Hyperscalers like Google and Amazon are developing in-house chips, but those are optimized for narrow specific workloads. They can't replace a general-purpose GPU across a wide range of applications. Second, and this is the deeper moat, customer switching costs through CUDA. CUDA is NVIDIA's proprietary software platform, and it has become the standard language AI developers use to build and train models. It only runs on NVIDIA GPUs. Every model trained on CUDA, every developer who has built their workflow around it faces enormous friction switching to an alternative. Even if a competitor built a chip that matched NVIDIA's hardware specs tomorrow, the code isn't portable. That incumbency advantage is structural. NVIDIA doesn't just sell chips. It sells the ecosystem developers are locked into. That's what makes this moat genuinely wide. Now, before we get into the numbers, every data point you're about to see, I pulled it from Fiscal.ai. Moat ratings, returns on capital, growth, balance sheet, and valuation, all in one place. It's the research platform I personally use for every stock I analyze. Link in the description for 15% off. Returns on capital tell us how efficiently management turns investor dollars into real profit. NVIDIA's return on invested capital is 135.4% and return on equity is 101.5%. Those are not typos either. Now, a quick note before the peer comparison: because NVIDIA's fiscal year ends in January, Fiscal.ai displays their figures 1 year ahead of calendar peers. So the chart you're seeing excludes NVIDIA to keep the comparison clean and avoid confusion. Among peers, Intel's return on invested capital is 0%, recovering from minus 12.8% last year, a business under serious structural pressure. AMD is at 6.6% and has been trending sharply downward since 2020. Broadcom comes in at 17.1%, which is solid. Same story on return on equity. NVIDIA is at 101.5%. Now on to peers. Intel is at 0%, AMD at 7.1%, and Broadcom at 31%. These are real returns from real business operations, compounding at a rate that reflects genuine pricing power and capital efficiency. Growth is the engine that drives long-term value creation. Over the last decade, revenue grew at a compounded annual growth rate of 51.8%, and net income grew at a CAGR of 67.9%. Earnings per share has grown at a staggering 69.1% CAGR. Slightly ahead of net income because share buybacks restarted in 2023 and accelerating are amplifying per share returns for long-term holders. For the peer earnings per share comparison, I'm showing the 10-year chart first for full transparency, but I can't calculate a clean 10-year CAGR for this group. Intel had negative earnings in fiscal 2025. AMD and Broadcom both started from negative or near zero earnings in 2016. So for an apples-to-apples CAGR, I'm using the most recent 5-year period. Over 5 years, AMD grew earnings per share at 5.3% annually, Broadcom at 49.7%, and Intel remains incalculable due to losses. NVIDIA's 69.1% over the full decade puts it in a category of its own. According to Morningstar Research, NVIDIA's data center revenue is projected to grow to $333 billion in 2027. That's 72% annual growth. That figure seems conservative, as NVIDIA's management has guided to over $1 trillion in cumulative Blackwell and Rubin product revenue from 2025 through 2027. The growth story here isn't slowing, it's scaling. Financial strength is our sleep at night factor. Can NVIDIA survive a downturn and keep investing through it? Total cash and cash equivalents is $62.6 billion. Total debt is $11 billion. Total free cash flow is $96.7 billion. The free cash flow to total debt ratio is a staggering 879%, where the minimum threshold for financial health is 10%. NVIDIA's balance sheet is outstanding, and they generate more than enough cash flow to cover all obligations, capital expenditures, and shareholder returns simultaneously. This is a company that funds the AI revolution from its own cash flow. That's a rare combination of scale and financial strength. Even the greatest business can be a poor investment if you overpay. Valuation is the final filter for our margin of safety. NVIDIA is trading at a forward price to earnings of 25.4. In historical context, the minimum was 19.8, the median is 35.2, and the maximum was 66. NVIDIA is currently trading below its historical median, which for a business growing at this rate is notable. Compared to peers, Intel is at 105.9, reflecting near zero earnings, AMD at 47, Broadcom at 30.6. NVIDIA at 25.4 is the cheapest in the group on a forward PE basis. Now on to the price to earnings growth ratio, because PE alone ignores the growth side of the equation. Based on a long-term analyst earnings per share growth estimate of 38.9%, NVIDIA's forward PEG is 0.65. A PEG ratio below 1 is undervalued, between 1 and 1.5 is fair for quality, above 1.5 is expensive. At 0.65, NVIDIA's PEG signals deep undervaluation relative to its projected growth rate. The market is paying less than 1 times growth for the dominant AI infrastructure company in the world. NVIDIA looks cheap on every metric, so what's the catch? The market usually isn't stupid, and a PEG ratio of 0.65 comes with a reason. Here are the 4 risks keeping the valuation in check. Customer concentration. Just 2 unnamed customers made up 36% of fiscal 2026 revenue. Geopolitics. China restrictions have already cost NVIDIA a major market and could tighten further. In-house chips. Google's TPUs, Amazon's Trainium, and Meta's custom silicon are often cited as competitive threats. But these are ASICs, purpose-built for narrow, specific workloads. They can't replace a general-purpose GPU across the range of applications NVIDIA serves. This is fear in the market and, in my view, largely unjustified. And finally, cyclicality. Morningstar itself models a flat revenue year in fiscal 2032, anticipating a demand pause at some point in the cycle. The PEG of 0.65 isn't the market making a mistake, it's the market pricing in the probability that some of these risks materialize. The question is whether the growth runway is long enough to outweigh them. And given a 69.1% earnings per share CAGR, an 879% free cash flow to total debt ratio, and a CUDA moat no competitor has been able to crack, I think the answer is yes. Let's bring this together to our 5 key factors. NVIDIA has a wide economic moat, built on GPU intangible assets and CUDA switching costs. Returns on capital are elite, with 135.4% return on invested capital that no peer comes close to matching. Growth is extraordinary, with a 69.1% earnings per share CAGR over the last decade. And the forward pipeline is suggesting the cycle is accelerating, not peaking. Financial strength is exceptional, with a free cash flow to total debt ratio of 879%. NVIDIA trades at a forward PE of 25.4 and a PEG ratio of 0.65. suggesting strong undervaluation. Is the AI infrastructure build-out just getting started, or is the cycle closer to the end? Let me know in the comments.